The national flag carrier Kenya Airways released half-year numbers for the period ending June 2022 on the 24th of August, and we're delighted to have the Chief Financial Officer, Hellen. Karibu sana.
Asante sana.
The numbers released yesterday by KQ have very compelling bright spots and also some very disconcerting dim spots. Let's start with the bright spots. In the present environment, where many companies are grappling with cost escalation, KQ's top line was up 76%. Costs were up just 53%. Give us some shape and form around balancing those two.
Okay. In terms of costs, and you'll understand in for airlines, cost is driven by the network. So what happens is that you try as much as possible to match your demand to the supply. You match your supply, that is the capacity that you're deploying, to the demand that you're seeing. So what we've done in the first half is to continuously review our routes as we start up, because remember we were grounded for almost 2 years. So as we started up, we ensured that we are looking at demand as it develops in the markets, both the old markets and the markets that we are looking into entering, and deploying capacity in line with what we are seeing. So for each route, you evaluate the route not just on its own merit, but the value it adds to all the other routes. So that's what we call the network value, so that you're able to ensure that in totality, your costs will come down, but you're also ensuring that you have more passengers, and the more passengers you have on board, the more revenue you get.
Okay. Speaking about matching the capacity with the demand, we saw a bit of route rationalization sometime, I think, late last year. To what extent has that played in the numbers that we have seen?
So before we decide to rationalize a route, of course, we do have steps that we take to ensure that we have done all possible to revive the route, because to some extent each route has value in the network, and we only cut it out when we are completely sure that we are not, we've tried to stimulate demand and the demand is not stimulating, but we are able to also still serve that market using alternatives. So we decide to cut back capacity for purposes of cost reduction, but we still are able to serve market with alternatives, maybe using partners and such like things.
Okay. Still on the cost side, the nature of aviation is that you deal with the very heavy fixed costs. And I remember when COVID struck, one of the conversations we were having with airlines was the need to quickly switch some of your fixed costs into variable costs. Could you give us some insight into how that is evolving, and especially when you look at your present numbers, how is the fixed cost absorption impact there?
Okay, so immediately COVID struck, what we did is we started engaging our key suppliers in various markets. Of course, for the variable costs, once you don't operate, then you don't incur the variable costs. So we targeted the fixed cost suppliers. So those are aircraft owners, rentals, and such like things. So for rentals, we went and had discussions on rent reductions, and even we did get rent holidays for some cases. However, for aircraft, we entered into power by the hour discussions, where we were to only pay for the utilization. So they became variable for that period. And what happens is that you end up discussing with the lessors to give you that power by the hour, for you to also give them, you have to give something for you to get something. So what happened is that in the end analysis, we ended up extending some of the contracts, maybe by 1 year or 2 years. Again, those decisions are informed by the fact that you want to keep that kind of aircraft, because it still serves you well in your network. So for all those aircraft that we felt that are serving us, they are needed in the network, we did extend by 1 year or 2 years for purposes of reducing or rather changing the fixed nature of the costs for that period to a variable nature. And so what happens is that you instantly gain a cash flow benefit. However, from a P&L, or that's a profit and loss statement, you will spread the gain over the remaining period of the lease or the rental period. So you will, for example, from a cash flow perspective, you might get about 40% gains immediately, so you conserve cash, and then you'll feel the impact from a P&L maybe at a lesser rate of about 12 to 15%.
Okay. And And does KQ still have any wiggle room around this conversion from fixed to variable? Because we seem to have gone back to normalcy, business is back. Look at your top line, for instance. It tells you business is back. Do you still have any more breathing space as far as that conversion is concerned?
So we are currently going through a restructuring phase, and we expect to close this maybe by 30th. So we are negotiating on our lease rentals to structurally not move them to variable, but structurally reduce the costs. Yes.
Okay. And now that you preempted that conversation around the engagement with the lessors, when you want to ease the cost, what options really are on the table? Already we have seen some saving being realized as far as the fleet management is concerned.
So for you to ease the costs, there are only two options. And the options is either to cancel a contract, and if you cancel a contract, then that means you have to pay the penalties that are associated with that contract. The other option is to just go into a consensual discussion with the lessor and agree on a reduced rental. Again, remember these are assets that are owned by another person maybe, and they are using them for purposes of their business. So you have to either extend or give them some benefit. And the only way you give them a benefit is through the extension of the lease agreement.
Okay. Clearly, you're hinging more on the latter. One of the things which surprised me was for KQ to indicate that for the period under review, it had no open positions as far as fuel hedging was concerned. And why that was surprising for me is that if you go back to about late Q2, start of Q3 2020, we could see the price of oil was beginning to tick up. To what extent is the state of your balance sheet a constraint as to the capacity within which you can go into the hedging position?
Okay. In terms of making decisions on the hedge, or rather taking positions on the hedge, of course, your balance sheet does dictate in terms of the terms you get. So counterparties will first review you for purposes of your credit rating, for them to give you deferred premiums. The alternative is you do upfront payments. At the same time, before you make a decision on whether to hedge or not, it's very clear. You have to be very clear, what are you hedging? You're not just hedging for purposes of speculation. You're hedging a certain decision or a certain point, and those decisions are taken in collaboration as a business in terms of what is important at that point in time for purpose, especially for a business our type. A lot of cost benefit analysis has to be done to make decisions because you have to take the best position overall, not just taking into account one line in the P&L.
So when you see the market in its present state, we've seen a bit of easing and softening of prices right now. Does KQ have bandwidth to undertake this now?
We have had discussions internally. We have bandwidth, but again, you also need to know how much will be effective. Our volumes are heavy. So if, for example, you have just enough bandwidth for 10% to not tick to not move the needle. So we need to ensure that we have clarity in terms of the amount we're going to hedge for it to be effective, and what other item are you foregoing, in terms of your cost benefit analysis. Yes. Yeah.
Still on your balance sheet, in February this year, February 4th actually, the National Treasury issued a statement regarding support for KQ to the tune of about 26.6 billion shillings. How much of this has come through?
Yes, indeed, they did mention that they are supporting us, and yes, we've worked in collaboration with the National Treasury and are really grateful for the support they've given us throughout, especially throughout the COVID period. And yes, they are supporting us throughout the restructure with clear milestones, and once those milestones are achieved, they are supposed to be funding us based on the clear milestones that we have set up. Out of the 26.6, they gave us 6.27 based on the achievement of the first milestone. Yeah.
Okay. And the milestones, we understand, are predominantly pegged on cost management. Looking at your H1 numbers and hoping you can replicate them in H2 or even better, Do you feel it would have been wiser to peg your milestones on revenues as opposed to costs? Or maybe a hybrid of the two?
Actually, it is a hybrid of the two, because when you think about the specific buckets they are looking at, it is when you talk about working capital is basically already taking your revenues and your costs, yeah. And if that is a milestone on its own, it's already taking the two. So you have to grow your top line and reduce your costs for purposes of achieving that milestone.
Let's talk about FX. First, there's been so much confusion around blocked funds pertaining KQ. I want to give you this opportunity to clear the air, because in the presentation there was indication of at the global level we have about $1.6 billion in blocked funds, $1 billion of which are attributable to Africa. How does KQ play within this space? So
you have actually stated it correctly. Yes, it's 1.6 globally for all airlines in blocked fund countries in the world. Then specifically for Africa, where we have blocked funds countries, it's about 1 billion. Yes, KQ has blocked funds in specific countries. We have not mentioned the amount for obvious reasons. It's a small amount. It's not $1 billion. It can't be $1 billion. Yes, so it's a much smaller amount, and we are working with our government through the Ministry of Foreign Affairs to support us in terms of managing to repatriate those funds. And again, just to clarify, by the time you're talking about blocked funds, you have utilized all utilize your earnings to pay off all the expenses in that country. So these are the profits that you need to bring back for purposes of supporting your business. Yes. So, and the key markets we have mentioned this time and again is mainly Nigeria and Ethiopia for us.
I see. Still on FX, companies which have hard currency denominated debt in this period have really struggled in terms of servicing debt obligations, because we are having a bit of a situation in this country and a few others. For KQ, given the sort of inflows you receive in hard currency, how has the situation been?
So for KQ, in terms of our earnings, normally about 40% is in USD. And in total, when you look at hard currency, we are at about 65%. At the Kenya shilling, we are at 70%. So we don't struggle normally to look for currency to pay off our dollar-denominated obligations, or even euro or GBP-denominated obligations. We are able to use the currency that we collect to service those obligations.
Okay. And still on the issue of debt, is KQ still enjoying any moratoria as far as debt servicing is concerned?
Yes, we still have moratoria, and we have enjoyed it, but it's coming to an end. Yes.
When is it coming to an end?
In September. Yes, in September.
Wow, I see. In your numbers, I saw investment income up from 52 to 107 million shillings. What's that about?
First, of course, it's the collections. Remember, in terms of revenues, we are collecting more, and we have entered into arrangements with our key bankers for purposes of continuously sweeping off currencies sweeping off cash from the current accounts into call deposits. So we have short-term call deposits, mainly about 7 days. So we are able to continuously accumulate funds, and then the way we do our payments, we have structured them on a weekly basis. So we release heavily on Fridays. So everything you collect sits in the call deposits, and then we utilize. So you end up getting income from that. Yeah.
KQ has set itself the ambitious target, ambitious in my view, of at least breaking even by 2024. I was doing my math going back and seeing how you are trimming your losses and growing your revenues. And my view is that you need some headroom beyond 2024, maybe taking you to 2027 or 28 to actually just break even. Don't you think it's very ambitious?
No, it's not. By the time we are setting the targets, we have sat down as a team, management team, and reviewed the various actions that we need to take for the period between now and actually we set the target in 2020. Yeah, so the actions that have gone through in 2020, 2021, and 2022 are positioning us towards breaking even. And some of the things, just to mention maybe one or two, is route maturity. So especially when you invest in long haul routes, maybe singling out for KQ the New York route, which is an investment. In the first 3-4 years, you heavily invest. And how you invest is, fine, you've put out capacity there, you need to ensure that you're filling that capacity and you're growing it continuously. The more frequencies you have, the lower your costs, your cost base. So the way you do it is, of course, entering into relationships with other airlines for purposes of getting more flows into your metal, and then in the process you're able to have more passengers. So by the year 2023, this route will be fully mature. It is actually right now mature. We are considering it almost mature at this point in time, but it will be fully mature by 2023, 2024. So it's no longer an investment. So we do not foresee ourselves introducing any other very long haul route. So we'll mainly concentrate on Africa and then feeding the already established long-haul routes. So that's why we think, or we believe, that 2024 we should be able to break even.
And on that same note, so you've given us one of the anchor views around route maturity, but someone would again ask, so what risk scenarios are you looking at in terms of, for instance, when you were starting this year, nobody thought Russia-Ukraine would have such spillovers and clearly affecting your numbers. So what sort of risk scenarios are you playing out here in terms of the 2024?
Of course, yeah, there are a number of risks, and COVID being one of them that really taught us that you can actually end up grounding completely the airline or the aviation sector. So as we are looking at things like, of course, fuel is a key macro. We're also looking at the economies specifically because we are playing in Africa, predominantly in Africa. We're looking at the economies and projecting the growth. The other key item that normally affects us is political environments. And as we have seen of late in Africa, the elections are not as disruptive as they used to be. In the past, actually, we used to provide heavily for election periods. We've seen that right now they are not as disruptive as they used to be as the economies or the politics of the various African countries mature. So we have factored in, of course, the key, some of those key events within the projections. From a fuel perspective, of course, no one has. Yes, you cannot be very clear that this will be the prices, but we do take a position in time, guided by the various experts that continuously study the fuel. So we take a fuel curve at any point in time, and we basically use that. So of course, the other things of when it comes to fuel, you have the fuel hedge to basically mitigate your risks. So for that period, yes, we have factored in fuel hedging as a cost within those projections, and also the benefit that comes with it. Yes.
What should we expect from the KQ SAA partnership? It was made very categorical. It is not a merger. It's a partnership. What should we expect from it?
So it basically offers the two airlines growth without necessarily having to invest heavily, because you're able to utilize each other's strengths, and the strengths can be the assets in terms of the aircraft. So right now, what we have sided with is code shares, yeah, but you can extend that into even joint ventures, whereby you're opening routes and flying to various destinations without necessarily the two of you flying and competing. Yeah, There's also other benefits that you'd have, like for example, SAE is a flag carrier for Southern Africa. Of course, they have assets like their lounge. Kenya Airways has a lounge in Nairobi. How do you ensure that the two of us are able to access and have premium, our passengers accessing premium facilities at reasonable costs? We have engineers here, they have engineers there. Do you really need to overemploy? Why don't you use each other's resources? So there are a lot of benefits whereby you are able to utilize the resources that you have and grow, as opposed to each of us investing. So you only start investing once you have reached the peak of all the resources that you have.
Helen, I wonder, would a JV arrangement within the East African region have more dividends, or potentially just as much as you're having with SAA, considering your focus within this region?
It would be beneficial to work together as opposed to competing. It does give benefits, because in the process, what joint ventures do is they utilize assets better. Yes. So instead of two aircrafts, one following the other within maybe an hour, you can actually even space them. Yeah. And be able to utilize, because you're not competing for the same time channel.
Yeah.
In the end analysis, what you're doing is that you're going to pool all your revenues and your costs together. Then you'll be able to divide. So your costs are together, your revenues are together, you work collaboratively. It would make more sense. However, we have not studied it. We are yet to study it, but high level, I think it would make economic sense.
Still on the continental level, Helen, AFRA has been having a conversation around setting up an umbrella body for African airlines when it comes to matters like service of aircraft, procuring fuel. How far are we with this, if I'd imagine you have some insight into this?
So far we work together as African carriers in procuring fuel. So we work through AFRA, and what happens is that I think it's around November or October there, we do come together with, for example, all the markets that you fly to, and we send out tenders together. So volumes, of course, you end up getting better discounts. So that one is already working. So we are moving to the space of, I think currently they're doing training. Then thereafter they will move into maintenance and ground handling. Yeah, those ones are yet to be developed, but fuel is developed.
There is a question as to what sort of stickiness are you seeing in terms of your demand, because we are having an environment where costs are going up. From a pricing and market dynamic, are you altering this to reflect the cost pressures you are facing? And how is your demand responding to that, if at all you're doing that?
So I think airline is among the few businesses whereby it's not cost driven. It's mainly demand driven. So what we do is the markets basically sort of like dictate the price. So you can only test, you keep testing, and for us pricing is very dynamic. It is changing every minute. So you keep testing and seeing how the demand, or rather the uptake is. If it's not good, you adjust. So we are continuously adjusting for purposes of taking advantage of, not really taking advantage, but ensuring that we are able to also cover our costs, because we also have costs. But in the end analysis, it is more demand driven, and the more you push the demand, or rather the more you get, you stimulate the markets, the more you're able to cover your costs.
Is KQ planning to release any further aircraft? And why I'm asking that is because we saw the sort of heavy lifting that did in the present numbers. Is there any plan for still replicating that going forward?
Okay, so we currently have we have two ways of acquiring aircraft, which is of course the owned. So the owned will stay with us. We are not selling any. The ones that are leased, We have 2 that are coming to end of that have come to end of lease, and we are in the process of preparing them for return. So they're in the shops for service, so that you're able to meet your return conditions for purposes of return. So only 2 are leaving, and these are the Embraer E190s. Yes. The rest are with us until either end of lease or we decide, actually end of lease. We do not anticipate reducing the aircraft numbers.
Closing this, how is the subsidiary JumboJet doing?
JumboJet is doing quite well. Interestingly, domestic recovered faster than international. They are at 120% of 2019 levels in terms of demand. Demand, yes. And they're also going through the same process of restructuring in terms of their fixed costs to ensure that they're able to reduce that also. So they are they are recovering faster than us, because as we're being pulled behind by the international aspect, again, not Europe or China, but regionally. Even when you look at the numbers that, in terms of the projections that have been put out there, Africa was expected to lag behind in terms of recovery, and we are seeing that in the results. So you can see even cabin factors for Africa are still in the 60s, but when you look at Europe, 80s, and you can see there's really big recovery. In fact, even frequencies for some of the markets are almost at 2019 levels, whereas Africa, some of the markets, we are not yet. We are about 60% of 2019 levels.
The gold rush to the DRC market, we saw JumboJet not too far back launching to Goma. How is that route doing?
It's a new route, and as usual, it's an investment. So they have invested, but they are breaking even. I think contribution-wise, it is contributing positive to the network.
And the breaking, I was interested in the breaking even point. You're already going to finish, then you left it.
It depends on which level of break even. And that's why I decided to settle at the contribution point, because that's also a break even. You're contributing positively to the network.
Thank you so much for your time.
You're most welcome.
I really appreciate it.
Asante.